Today, we're breaking down some of the most common Bitcoin myths and criticisms. The idea that rising prices alone prove nothing, that inflation isn't a problem, and that Bitcoin's price is manipulated. We'll show how these claims misunderstand what makes Bitcoin valuable, how its market works, and why its scarcity and resilience matter. Welcome to BitcoinBytesHQ, simple Bitcoin explainers. This is not financial advice. Let's go.
Let's start with a general concept: price discovery. In any market, whether for stocks, commodities, real estate, or luxury goods, price is determined by the interaction of buyers and sellers. Participants express what they are willing to pay and what they are willing to accept. When these bids and asks meet, a trade occurs, and that traded price becomes the market price. This process, called price discovery, reflects the collective assessment of value at any given moment. It's how markets decide what an asset is worth, even if individual participants might disagree with the final valuation. Bitcoin works in exactly the same way. Its price is not set by a government, a company, or a central authority. Instead, millions of participants across global exchanges determine its price every second. Buyers place bids, sellers place asks, and trades occur when the two meet. These trades, aggregated across exchanges, reflect real supply and demand. Temporary manipulations on small exchanges or thinly traded altcoins cannot permanently dictate Bitcoin's price. The global market continuously sets and adjusts it. To illustrate market-assigned value, consider a rare Lamborghini model. Only a limited number are produced each year, and their prices are determined entirely by what buyers are willing to pay. You may not agree with the valuation, but that is what the market decided. Bitcoin is similar. Its price emerges from collective agreement across a global market, based on scarcity, adoption, and macroeconomic factors, not because any single actor sets it. Now let's address the criticism that number go up does not equal success. Skeptics argue that rising prices alone don't prove Bitcoin is useful, viable, or here to stay. At first glance, this seems reasonable, but it ignores the fundamentals. Bitcoin has been around for more than 15 years, surviving multiple market cycles, extreme volatility, and intense media scrutiny. On its own, longevity doesn't guarantee success, but when you combine this track record with Bitcoin's current global market value of around $1.4 trillion and an all-time high of over $2 trillion, it becomes clear that Bitcoin is far more than a short-term experiment. Any claim that it is merely a bubble or the product of coordinated pump and dump schemes ignores the fact that sustained manipulation over such a large, decentralized, and valuable network would be virtually impossible. Next, let's talk about inflation. Another common claim is that inflation isn't a real problem, and therefore, Bitcoin isn't needed as a hedge. Critics often assume that governments can manage inflation effectively and that traditional systems are sufficient. But inflation represents a real risk, the erosion of purchasing power over time, especially when currency supply is controlled by discretionary policy. As Milton Friedman famously said, inflation is taxation without representation. Bitcoin's fixed supply of 21 million coins, enforced by its decentralized network, creates a predictable alternative. Its scarcity and neutrality allow it to act as a hedge against currency debasement, because its supply cannot be expanded at will, unlike fiat money. Real-world examples make this very tangible. In recent years, countries like Venezuela have experienced persistent and very high inflation, with the bolivar losing large amounts of value and forcing citizens to find alternatives for savings and transactions. Argentina has faced sustained inflation pressures, with the peso weakening against other currencies and prices rising rapidly. Even in countries with relatively stable currencies, inflation slowly erodes purchasing power over time, Essentials like housing, food, and services rise gradually in cost, and if wages don't keep pace, people effectively lose spending power year after year. Because this erosion is gradual, it's harder for many people to feel it, even though the cumulative impact can be significant. The risk is systemic. Over 100 fiat currencies have failed since 1900, showing that even official government money can collapse completely. Bitcoin was designed to address exactly this problem, a monetary system with a predictable, capped supply that cannot be inflated away by policy choices. When people expect persistent inflation or loss of purchasing power, demand for scarce alternatives like Bitcoin rises, and that expectation becomes part of Bitcoin's market price discovery, alongside adoption, network effects, and macroeconomic trends. Some critics point to academic studies on manipulation, suggesting Bitcoin's price is artificially controlled. For example, a 2025 paper published on the ARIV preprint server hosted by Cornell University analyzed coordinated pump and dump schemes and identified individuals orchestrating artificial price movements. The research, conducted by independent researchers, examined a few hundred actors behind these manipulations, but it's important to note that this is a finding about human behavior, not a flaw in Bitcoin's decentralized protocol. Coordinated trading is something humans do in every market: stocks, commodities, real estate, and even in everyday life. Bitcoin's network itself remains neutral, predictable, and censorship-resistant. Its price is ultimately set by millions of buyers and sellers across global markets, and short-term distortions do not undermine the system's integrity or long-term price discovery. Because Bitcoin's market is massive and liquid, large-scale manipulation is far harder to sustain than it is with smaller altcoins, which are thinly traded and easier to influence. Institutional perspectives are often cited as proof that Bitcoin's value is questionable. Many professional money managers were initially skeptical, not because Bitcoin is inherently flawed, but because they didn't fully understand its mechanics, economics, or potential. Larry Fink, the CEO of BlackRock, the world's largest asset manager with over $14 trillion in assets under management, is a prime example of someone in a highly influential financial position who initially approached Bitcoin with caution, but has since publicly embraced it as part of the broader financial ecosystem. Similarly, Vanguard, managing approximately $11.6 to $12 trillion in assets, has historically cautioned clients about speculative risks, but now permits access to Bitcoin through third-party ETFs, reflecting growing institutional recognition. This illustrates a consistent pattern. Initial skepticism gives way to measured adoption once the fundamentals and network effects are fully understood. Even with cautious institutional participants, no single company or manager sets Bitcoin's price. Price discovery continues to emerge from the global interaction of diverse market participants. So, when someone claims number go up doesn't mean success, inflation isn't a problem, or that Bitcoin is manipulated, they are misunderstanding what creates Bitcoin's value. Price is discovered through millions of independent trades influenced by scarcity, adoption, macroeconomic conditions, and inflation expectations. Short-term distortions may occur, but the system itself remains neutral, predictable, and censorship-resistant. Bitcoin is not about hype or control by any single actor. It is about providing a decentralized, reliable monetary network with real-world utility. That's Bitcoin price discovery, inflation, and market dynamics explained. If this helped, like, share, and subscribe for more Bitcoin explainers. Drop your biggest takeaway in the comments. I'd love to hear your thoughts. See you in the next one.